Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at security matters.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis of security matters. This is a complex one.
Yeah.
Because you're looking at a stock that's really pre-scale. But the thing is, it possesses what I think is a genuinely unique technological foundation.
Okay.
For any potential investor, I mean, the entire thesis rests on the competitive moat of their core traceability solution.
Right, let's unpack that technology, because on the surface, supply chain traceability sounds like a really crowded space.
Yeah.
You've got companies offering QR codes, RFID tags, all sorts of software. What makes their approach so special, and why is it supposedly so hard to replicate?
What's fascinating here is that they've built a three-component solution. It marries the physical world with the digital.
Yep.
It starts with a proprietary marker, a molecular or even submolecular compound. Then there's a specialized reader, and finally, it's all logged on a blockchain platform. They call it the digital passport.
The marker is the key, then.
The magic is in the marker itself, exactly.
So explain the marker, because if it's invisible and, embedded, how does that fundamentally change the game compared to, say, a GPS tracker or just a barcode sticker?
Think of it this way. All those traditional methods, they track the container or the packaging, or they rely on a label that can be detached, forged, or swapped. They track a data record about the item.
Okay.
Security Matters embeds these invisible molecular markers directly into the material itself. It doesn't matter if it's a solid, a liquid, or even a gas.
So if you're tracking, say, a plastic bottle, the marker isn't on the label. It's literally mixed into the polymer of the plastic itself.
Precisely. That's what creates a tamper-resistant physical-to-digital twin.
A physical-to-digital twin.
It's like molecular DNA. You can remove a sticker, but you cannot remove the DNA from the object without destroying the material.
So it provides that molecular level assurance.
Exactly. If you read the material, you know definitively where it came from, no matter how many times it's been melted down, recycled, or repackaged.
That distinction tracking the material versus the data record, that really is the foundation of the bull thesis, isn't it? It addresses the weaknesses of, well, every current system.
And not just that. This technology is aligning perfectly with these huge global secular trends, things that are becoming mandatory, not optional.
You're talking about ESG?
Absolutely. We're talking about massive forces like ESG, environmental, social, governance initiatives, the push for a truly circular economy.
Where you have to prove you're using recycled content.
Verifiable tracking is critical there. And of course, the perennial battle against counterfeiting, which costs industries hundreds of billions.
I think the most important tailwind you highlighted is that growing push for mandatory digital product passports. That's a big deal, especially with the new regulations coming out of the EU. Why does that specifically favor a molecular marker solution?
Because regulators are finally recognizing that a simple declaration, this contains recycled content, isn't enough anymore.
They need proof.
They need verifiable molecular level proof to enforce these mandates. This solution is tailor-made to provide that compliance. It enables a permanent, unchangeable history for a material, which is exactly what the digital product passport requirements are demanding.
So it's moving beyond just tracking. It's about authentication.
It's about authenticating the material's existence in this entire journey.
Okay, so the technology is compelling. It's IP-rich, and it's riding a massive regulatory tailwind. But that kind of deep science and sophisticated integration, a proprietary marker, a specialized reader, a blockchain backend, that must cost a fortune to develop. Let's get real about the short-term financial picture, because that has to be the central risk.
This is the high-risk, high-reward profile in full view. Despite the groundbreaking tech, the company is, well, fundamentally pre-scale.
Modest revenue so far?
Very modest.
Okay.
It's based mostly on pilot projects and early deployments, which is typical for this kind of B2B infrastructure.
Yeah.
They're still reporting sizable net losses, around $31 million annually.
So they're burning cash.
That money's being burned? Yes. But it reflects heavy ongoing investment in R&D, scaling up production, building out the commercial teams. Free cash flow is negative.
And for you, the listener, what that $31 million annual burn means is that until very recently, solvency was a constant pressing issue. The stock was trading as a microcap with a huge question mark over whether it could even fund its own operations long enough to hit commercial scale.
And that entire narrative changed dramatically with a game-changing capital injection.
The big deal with Target Capital.
A substantial $100, $11.5 million equity purchase agreement with Target Capital One.
Hmm.
It wasn't a straight cash infusion, though. It was structured as a convertible note plus a very large $100 million equity line of credit.
That is a huge number for a company of this scale. What's the immediate material impact of securing that much optional capital?
It extends their financial runway materially.
Yeah.
It basically takes the near-term solvency risk right off the table.
So management can breathe.
Management can breathe and focus on maximizing the value of their technology rather than just surviving quarter to quarter.
Yeah.
They can now go after those long-duration, high-value projects, like building the infrastructure for precious metals traceability.
Which has a much higher barrier to entry.
Exactly, but potentially enormous returns.
But we need to talk about the catch, though, because that $100 million isn't free money. It's an equity line of credit. For our listeners who might not be familiar, what's the trade-off? How does that dilution risk function?
The dilution risk is significant and direct. An equity line of credit essentially lets the company demand that Target Capital buy shares from them up to that $100 million limit.
At a discount to the market price.
At a slight discount. Whenever the company needs cash, it's flexible. But if those shares are issued aggressively, especially when the stock is volatile, it just floods the market with new shares.
And that heavy influx of new shares acts like a persistent ceiling on the share price.
It can, yes.
So the company gains this incredible flexibility to pursue plastics, precious metals, fashion, all at once. But they pay for it with potential dilution.
It's a classic choice. Scale fast versus managing the share price. And this management team is certainly showing they are willing to take bold risks.
You're talking about the crypto.
The sources pointed out a very unconventional asset strategy. Management flagged an intention to allocate a portion of the new capital to reserve assets like Bitcoin or other cryptocurrencies.
Wait, really? They're mixing molecular science and global supply chains with crypto treasury management. That sounds either incredibly progressive or wildly speculative, depending on your view.
It definitely shows a willingness to be unconventional, to be aggressive in treasury management. I mean, they're aiming to potentially hedge against inflation or capture upside.
I wonder what that message sends to potential institutional partners.
Well, whether it's seen as smart or reckless really depends on the investor's risk appetite. But it certainly adds a very interesting, highly speculative layer to their balance sheet. It is not a common move.
All right, let's turn to the good news that actually drove the market's recent re-rating, because the stock experienced an absolutely explosive move. We're talking a surge of over 1,000% in 5 days.
In 5 days.
That needs more than just a capital line. That requires fundamental proof that this thing works.
Exactly. This wasn't driven by hype or market sentiment. It was a true regime shift in perception. The market went from seeing security matters as a speculative survival story to a credible, scalable growth platform. And it was purely driven by news validating the tech.
Let's detail that catalyst stream. First, and I think most impactful, was the Goldstrom partnership. Why is precious metals such a critical vertical?
Well, precious metals, gold, silver, platinum, they're high value, high margin, and they suffer from massive problems with provenance, anti-laundering rules, ethical sourcing.
Huge problems.
A molecular marker that can guarantee the origin and purity of gold through their True Gold and True Silver subsidiaries solves an existential problem for that industry.
So this partnership means they're going after a vertical where customers will pay a premium for assurance.
It immediately shifts the perception from maybe they can track plastic to their foundational infrastructure for high finance.
And then you had the letter of intent, the LOI, with Cardiff in Europe. That feels like the gateway to mandated ESG compliance.
It is. Cardiff is a major technology center focused on sustainability and Industry 5.0 projects, specifically in Spain and the broader EU.
And an LOI isn't a contract, but it's serious.
It's a non-binding commitment that signals serious intent. Getting that LOI to integrate their tech into EU projects is a massive validation. It's their foot in the door to that regulatory tailwind we discussed.
And we also saw multiple announcements coming out of high-profile events, the Dubai conference, for example.
The presentation at the Dubai DMCC Precious Metals Conference resulted in the announcement of 6 strategic partnerships. That's real momentum.
It shows the Goldstrom deal wasn't just a one-off.
It's the start of a comprehensive vertical rollout. And we have to remember the Singapore Plastics Passport program, too. That is a critical proof point in the circular economy space.
Proving it works for post-consumer waste.
Demonstrating it can handle post-consumer waste, turning plastic scraps into verifiable, traceable, recycled input material. That solves a huge hurdle for large manufacturers.
So from a technical perspective, that explosive move with all those upside gaps puts the stock in a confirmed uptrend. But for those of you looking at the chart, what does that volatility mean for a potential entry point now?
It means extreme caution. When a stock moves 1,000% in a week, you have to be very, very careful.
Chasing it is risky.
Chasing a move of that magnitude is rarely a good idea. Technicians are typically looking for pullbacks, retesting prior resistance zones that now act as support for more disciplined entries. The fundamentals are strong, but the near-term trading risk is sky high.
Which brings us squarely to the bear case. The execution risks that are still there, despite the good news. Execution risk number one has to be converting all this intent into actual revenue.
Absolutely. The company must successfully transition from these promising yet non-binding LOIs like Goldstrom and Cardiff's 120-day evaluation into large, scalable, recurring revenue contracts.
And adoption cycles in this B2B space are notoriously long.
Exactly. These aren't consumer sales. They're enterprise-level, multi-year, multi-million-dollar commitments. They require proof of ROI, integration time, a lot of operational changes for the customer. That's the biggest hurdle to de-risk.
And execution risk number two circles right back to the balance sheet. The stock's history shows that pullbacks of 50% or more are plausible.
Yes.
And compounding that, you have the dilution risk from the new equity facility. If they draw down that capital aggressively, it could put a ceiling on the upside.
You need to watch those share count reports very closely.
And we can't ignore the current scale either.
It's still a microcap. The market cap is still in that $5 to $7 million range, depending on the day's volatility.
Which means wild price swings.
That, combined with a lack of broad mainstream analyst coverage, contributes directly to information asymmetry and those wild swings. You are truly doing your own groundwork here.
So given all this, what's on the immediate catalyst calendar for you to watch?
Near term, we have to watch for the next Form 6K or earnings update. That document will be crucial
To see the first revenue numbers from these deals.
to quantify any initial revenue contribution from Goldstrom and Cardiff. And just as importantly, to see how management is deploying the new capital. Is it R&D, commercial rollout, or treasury assets?
And of course, the key follow-ups are those partnership transitions, the outcome of the 120-day Cardiff evaluation.
Whether it converts from an LOI to a binding agreement, that's a huge catalyst for European expansion.
And we also need to see tangible progress on the Goldstrom rollout.
We need to see customers actively using the markers and generating that recurring revenue.
But let's reiterate that macro tailwind.
That's the ultimate foundation. The structural demand for verifiable data is only increasing. Tightening ESG and circular economy regulation globally is not going away. It's a powerful, long-term force creating demand for exactly what this company provides.
So what does this all mean for you, the listener? The investment case here really boils down to an option-like bet. A bet on whether this unique IP-rich technology becomes a foundational piece of infrastructure for global ESG and anti-counterfeit supply chains. It's the definition of a high-risk microcap opportunity.
But the upside is asymmetric. If they convert even a modest fraction of their opportunity pipeline, especially in precious metals and European compliance, if they succeed, you are looking at a platform that could revolutionize how we verify the materials that underpin global commerce. It truly is an option on the future of material authenticity.
If you found our analysis useful today, remember to subscribe so you don't miss our next talk on the markets.